Hello YouTube, Herman Williams with ATM Financial Services, here today with another Money Smarts lesson to help you take control of your finances. Now today we're going to continue with our series on retirement planning. In the previous two lessons we talked about the differences between a defined benefit or pension plan and a defined contribution plan, which is your 401k, 403b, your thrift savings plans, etc. We have also discussed the value of matching contributions, how to increase your contributions over time, and the huge advantage of starting early. In addition, we briefly discussed traditional and Roth IRAs. So if you missed those two lessons, please go back and view those to add to what you're going to learn today. Speaking of today's lesson, since we have covered the basic types of retirement plans, let's move on to the structure of these plans. In other words, what are some of the options you have within your plan? Today we're going to talk about mutual funds and exchange-traded funds, or ETFs. Now these are certainly not the only options you likely have available to you through whichever plan you have, but they are certainly two of the most widely offered and widely used options. Mutual funds and ETFs each have their pros and cons, so today I would like to talk about what they are, the good and the bad of each, and how you can use them to build your retirement portfolio. Let's start with mutual funds. A mutual fund is an investment option that is made up of a pool of money collected from many investors and is then used to invest in securities such as stocks, bonds, money market instruments such as T-bills and other assets. Professional money managers oversee the fund and allocate the collected dollars to a variety of assets that are chosen to meet the objectives as stated in the fund prospectus. In the case of mutual fund, the prospectus contains details on the fund's objectives, the fund's investment strategy, its risk, performance, distribution policy, fees, expenses, and fund management. The prospectus can be a good place to start when comparing mutual funds. Mutual funds are a good way for small or individual investors to gain access to professionally managed portfolios of stocks, bonds, and other securities. Each shareholder of a particular mutual fund participates proportionally in the gains or losses of the fund. Mutual funds typically invest in large numbers of securities. Performance is usually tracked as the change in the total market cap of the fund. We will talk more about market cap in another lesson, but for now, just view it as the total value of all the assets in a mutual fund. In fact, the share price for a mutual fund is typically referred to as its net asset value. When you buy a share of a mutual fund, you are buying the performance of its portfolio. In other words, how well is this basket of assets performing overall? Because some assets will be up while others are down. So at the end of the day, did the total value of the portfolio increase or decrease? By the way, unlike individual stocks that change in value in real time throughout the trading day, a mutual fund value changes at the end of the trading day after it has time to review the closing price of all the assets in the portfolio and determine whether the net value of the fund went up or down. The average mutual fund holds hundreds of different securities, which means investors in mutual funds gain important diversification at a low price. Think of an investor who buys only Amazon stock just before the company has a bad quarter. That investor stands to lose a great deal of value because all of their dollars are tied to one company. Now, a different investor may buy shares of a mutual fund that happens to own some Amazon stock. When Amazon has a bad quarter, this investor would lose significantly less because Amazon is just a small part of the fund's portfolio. Investors typically earn a return from a mutual fund in three ways. One, income is earned from dividends on stocks and interest on bonds that are held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Mutual funds often give investors a choice of either receiving a check for distributions or to reinvest the earnings to gain more shares. If you are working and trying to grow your portfolio, you should obviously choose to have your earnings reinvested. There's also tax consequences to consider if you decide to receive a distribution check instead. The second way a mutual fund investor can earn a return is if the fund sells securities that have increased in price. This means that the fund has a capital gain and those gains are passed on to investors. Mutual funds often buy and sell securities within the fund for a variety of reasons. The rate at which they exchange securities is often known as the turnover ratio. The third way a mutual fund can earn a return for investors is if the fund holdings increase in price but are not sold by the fund manager. This could cause a fund's shares or net asset value to increase in price. This means you could then sell your mutual fund shares for a profit, just like an individual stock that increased in price. Now, mutual funds come in a variety of flavors representing the kinds of securities they have targeted for their portfolio and the type of return they seek. There is a mutual fund for nearly every type of investor or investment strategy. The largest category of funds is equity funds, which, as the name implies, invest primarily in stocks. Within this group, though, there are also subcategories. Some equity funds are named for the size of the companies they invest in, small cap, mid cap, or large cap. We will talk more about market cap in a separate lesson. Other equity funds are named for their investment approach: aggressive growth, income-oriented, value, and others. Yet other equity funds are categorized by whether they invest in domestic stocks or foreign stocks. There are many different types of equity funds because there are many different types of equities. Mutual funds also come in the form of fixed income funds. A fixed income mutual fund focuses on investments that pay a set rate of return, such as government bonds, corporate bonds, or other debt instruments. In this type of fund, the portfolio generates interest income, which is then passed on to the shareholders. These funds are sometimes referred to as bond funds and are often actively managed. Because there are many different types of bonds, bond funds can vary dramatically depending on where they invest. For example, a fund specializing in high-yield junk bonds is much riskier than a fund that invests in government securities. Another point to consider is that nearly all bond funds are subject to interest rate risk, which means that if interest rates go up, the value of the fund goes down. This is because investors will want to move their money to securities that are earning the higher interest rate. One other fund that I want to touch briefly on under the mutual fund umbrella is index funds. Index funds have become extremely popular in the last few years. Their investment strategy is based on the belief that it is very hard and often expensive to try to beat the market consistently. So the index fund manager buys stocks that correspond with a major market index, such as the S&P 500 or the Dow Jones Industrial Average. This approach requires less research from analysts and advisors, so there are fewer fees and expenses to eat up returns before they are passed on to shareholders. These funds can be great choices for cost-sensitive investors. Other mutual funds include balanced funds, which invest in both stocks and bonds. There's also money market mutual funds that invest in safe short-term debt instruments, usually government treasury bills. This is usually a good, safe place to park the cash portion of your portfolio. You won't earn much return, but you won't have to worry about losing your principal either. There are also income funds, international funds, global funds, and specialty funds, but we won't get into those in this lesson. The last investment option I want to talk to you about today is the exchange-traded fund, or ETFs as they are affectionately known. An ETF is a type of fund that involves a collection of securities, such as stocks, that often track an underlying index, although they can invest in any number of industry sectors or use various strategies. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stock. One well-known example is the SPDR S&P 500 ETF, which, as you may have guessed, tracks the S&P 500 index. Its objective is to mimic the performance of the S&P 500. ETFs can contain many types of investment, including stocks, commodities, bonds, or a mixture of investment types. An ETF is a marketable security, meaning it has an associated price that allows it to be bought and sold. ETFs can also offer lower expense ratios and fewer broker commissions than buying stocks individually. Some ETFs can be traded with no commission at all. While ETFs can be a lower cost alternative to mutual funds, you have to be careful when choosing an ETF. Because some can be very industry or sector specific, you may be giving up some of the value of diversification. Also, please remember that some ETFs can be actively managed just like mutual funds, which means the expense ratio could be higher with some ETFs. Still, they are a good alternative for those who may not be able to initially afford some of the minimum investment requirements for some mutual funds. Some mutual funds require a $2,500 or $5,000 minimum investment, and some are even quite higher. So as you can see, mutual funds and ETFs can be a low-cost way to gain diversification and lower risk by spreading your dollars over hundreds of stocks. They allow you to focus part of your portfolio on a particular industry or sector if you so choose. You can choose a model that is very aggressive or very conservative. With so many choices, you can construct a portfolio that matches your risk tolerance and your investment return objectives without having to labor over thousands of individual investment options. Well, I hope this lesson has given you something to think about as you build on your knowledge of retirement planning. We will continue to build on this knowledge in future lessons. If you haven't already subscribed to my channel, please do so by clicking on the subscribe button below. And if you like this lesson, please give it a thumbs up. And with each new understanding comes the opportunity for new behaviors. So until next time, behave well.